Good morning. Welcome to Stock Market Today. It's Tuesday, December 3rd, 2019. I am your host, Dan Russo, Chief Market Strategist at Chaikin Analytics. Find me on Twitter. I am at Dan_Russo_CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email. It gives you daily stock ideas to consider in your inbox every trading day before the market opens. So U.S. equities were lower Monday on the heels of softer U.S. manufacturing data that was clearly in focus. REITs, industrials, and technology were among the underperforming sectors. Healthcare and financials outperformed. Energy and staples were the only sectors higher on the day. Treasuries were mostly weaker. With the curve steepening, the dollar was down on the major crosses. Gold finished down 20 basis points. WTI crude rebounded a bit, up 1.4%. So your outperformers, staples, energy, healthcare, REITs, industrials, tech, were your underperformers. And we get to the desk this morning. Futures are under pressure, trading near the worst levels of the morning after that lower close yesterday. Asian equities were mostly lower overnight, but China did close higher. European equities are mixed. Treasuries are stronger following yesterday's backup in rates. The dollar is stronger against the euro, but weaker versus the yen. Gold is up 40 basis points, and WTI crude is up 20 basis points to get us rolling on a Tuesday morning. So here's the structure of the S&P 500. Stocks pull back on trade concerns and economic data. So now we want to start thinking about those support levels. Near-term support is in the 30.30 to 30.50 range. Then below that at around 3,000. That has not changed. We are still above a rising 200-day moving average. Near-term resistance, though, we can start to think about the upside near 31.50. Last week's high as potential resistance in the near term. I still think the break from the range targets 3,200 for the index. As we highlighted yesterday, December is still a seasonally strong month, but the first half of the month tends to be a little choppy before giving way to strength in the back half. The RSI is in bullish ranges here, being rounded out of that overbought condition. Chaikin money flow is still bullish. So what I see is a market that was in a solid uptrend that just got a little bit of ahead of itself, right? We were overbought on the RSI, and now we're pulling back. The key here will be to watch how this indicator reacts on pullbacks. We want to look for it to hold in the 40 to 50 area to be a sign that momentum is still in bullish ranges. And all the while, we'd love to see Chaikin money flow remain bullish as well. So near-term pullback still above the breakout level, which is still support in the near term. Start to think about resistance at the 31.50 level. Should we rally from here? Let's take a look at the market in a minute now. What are we writing about in the note today? Chaikin Analytics clients are reading about the pullback on that U.S. data as well as trade concerns. We're highlighting support in the 300 to 305 zone for the SPYs, so that roughly translates into 3,000 to 30.50 for the S&P 500. Tech remains a strong relative leader, while discretionary actually held relative support. Remember, we looked at the consumer groups last week. We'll take a look at discretionary holding that relative support line that I was highlighting last week. And futures, as I said, do point to a lower open here today. And as we shift over to the major indices from a power bar perspective, we can see red across the screen. Dow losing 90 basis points, and the power bar ratio skews back towards the bears, 9-7 bears to bulls on that ratio. S&P 500 remains bullish despite the 84 basis point loss yesterday, 126 to 93 bulls to bears there. NASDAQ down over 1%, 28 to 16. Bulls to bears. Small caps were underperformer on the day, losing 96 basis points, 693 bulls to 300 bears. Bonds were actually under pressure on the day, which is a little bit surprising. Given the sell-off in the equity market, you would have thought bonds would have held up better, but they didn't. They sold off as well, losing about 1.5%, sending yields higher on the day. So according to the Chaikin Power Bar, small cap stocks and large cap stocks are still bullish, but the major markets across the board remain mixed. Let's hit our stock of the day now. Stock of the day, auto-generated based on the power gauge rating, is Morgan Stanley, coming to us from the Capital Markets Group. Morgan Stanley was an inline performer yesterday, down a like amount with the S&P 500, down 81 basis points to close at 49.08. MS has a very bullish Chaikin power gauge rating due to attractive financial metrics and very strong earnings performance. Technicals and experts are neutral, but the 20 factors, 5 in each of these 4 categories, give us our very bullish rating. We have a strong trend above a rising long-term trend line, and capital markets is a strong industry group. So Morgan Stanley, certainly type of name we want to consider looking at as a bullish idea. And then we look Market and model are in agreement, right? That very bullish rating is met with a stock that's been outperforming since mid-October. This was a big underperformer really for much of 2019 and now starting to outperform. That's what we call a personality change. Chaikin money flow is bullish. The only real concern that I have here in the near term is the overbought, oversold indicator is not really in an ideal position for a setup. Stock is consolidating after the breakout above the $48 level. So breakout traders, that breakout still holds above $48. Some might be waiting for an oversold condition. Can't argue with that mentality or that logic. What you'd love to see is a consolidation above $48 that produces an oversold condition on our overbought, oversold indicator to set the stage for a higher probability entry point. Either way, Morgan Stanley is a name that we want to consider as a bullish idea. Breakout traders, I think that signal's still live. For those of you waiting for an oversold condition, you want to add Morgan Stanley to a watch list. And then when it does become oversold, all else being equal, it sets up a more compelling entry point. Taking a look at our sector tracker now, movement in the major sectors over the last 5 days. Staples towards the top of the list, as is discretionary. The consumer groups actually have rebounded over the past week of trading. Since we highlighted it here last week on this show. All others are lower over the past 5 days. A lot of that carnage being done yesterday. Comms, utilities, healthcare, and materials, all lower marginally. Financials, real estate, middle of the road. Tech and underperformer. Energy continues to lag. And I will note that for the XLE, the energy ETF, our ETF power gauge rating did turn bearish again on energy this week. Remember, we've been saying we want to avoid energy, and that continues to be the case. And with the manufacturing data as well as the trade headlines yesterday, the industrials are under pressure. They are down nearly 2% over the last 5 days of trading. So a bit of rotation taking place. I want to give it some time to play out, see if it's counter trend in nature, and see if the trends assert. I think they are likely to. But we're watching the pullback. We're watching that support level on the S&P 500, and we'll take our cues from there. Right now, it looks like a little bit of a healthy pullback within the context of a strong trend, and we do still have the seasonals in our favor. Taking a look at our industry in focus now, bank services. All right, we've been talking about the banks a lot. We've been talking about financials starting to take a leadership position within the marketplace. That's largely been a function of the banks coming on strong with rates moving higher. So bank services over the past 6 months has been an underperformer by about 50 basis points. However, the power bar ratio, which measures future potential, is very strong. 53 bullish or very bullish stocks for the bank services group for only 2 bearish or very bearish stocks, and that earns it a rank of number 2 of the 21 subsectors that we look at. For those of you who are curious, what is the number 1 subsector? Well, it's the regional banks. If we were looking at KRE, that would be the number 1 subsector, and that's based on that power bar ratio. But within the banks, some names that you might want to consider when the setup is there, all with very bullish ratings: East West Bancorp, EWBC, Simmons First Bank, SFNC, and Umpqua Holdings, UMPQ. All of those stocks have very bullish Chaikin power gauge ratings within a group that has a very strong power bar ratio, ranked number 2 of the 21 subsectors. Let's take a look at the fund now. KBE, the ETF we use to track the banks, has a bullish ETF power gauge rating and is in a strong trend above a rising long-term trend line. We have this breakout here through the $45, $46 level being tested now on a slight pullback. Here's that underperformance going to outperformance for the banks, coinciding with the power gauge ETF rating turning bullish for KBE. So a personality change at the ETF level. The same time, Chaikin money flow has turned bullish. But again, just like Morgan Stanley, our overbought, oversold indicator is middle of the road here. I think odds favor a continuation higher and a continuation of this relative outperformance based on the power gauge rating. But as always, we want to watch the market and the model. Remember, the financials and the banks were bullish within our model for a while, but we were waiting for the market and the model to get into agreement, and that now has begun to play out. We continue to like the banks and look for opportunities there, especially if rates continue to work higher. Taking a look at what's trending now. Monday's S&P 500 gainers and losers. There's XEC again. That one's been on both sides of the board for the past few days, up 3.7% yesterday. Nothing company specific that drove trading there. EIX, bullish stock, up 3.5% in a down tape yesterday. Like to see our bullish stocks outperforming, especially in a down tape. MRO, crude oil rebound yesterday, sends MRO higher by 2.6%. Same with Holly Frontier, HFC. taking part of that oil rebound up 2.25%. National Oil well Varco NOV up 2.2%. Another energy stock rallying with oil. Of those three, Holly Frontier HFC, the only one with a very bullish rating. On the loser side of the board, APA, some commentary on one of their wells sent the stock lower by 12.3%. L Brands, retail names were under pressure yesterday. L Brands down 5%. Some profit taking in Cadence. That stock was up over 4% last week. So it gives 4% back to yesterday. Aflac, AFL, lowered their guidance. That took the stock lower by 3.94% on the day. And Synopsys, nothing company specific there. The company is set to report on Wednesday after the close. Stock lower by 3.94%. Interestingly, Cadence and Synopsys are very similar. They are peers, software companies that service the semiconductor group, so they tend to trade in sympathy with each other. Let's take a look now at what we're talking about. We were talking about the IWM, the small cap breakout last week, and how it was encouraging. And now we're getting a test of that breakout level. The iShares Russell 2000 ETF, still above the 50 and 200-day moving averages. Here's that big consolidation that's marked trading for much of 2019. Now, last Monday, we had the breakout through the key 160 level, and we continued higher. Bit of a sell-off on Friday, and then a bigger sell-off yesterday to now pull back and test that 160 level. I think today's close is really going to be important here for the IWM. This is a key level at $160. We'd love to see a close above that level. With futures pointing lower here this morning, it stands to reason that level is going to come under some pressure in the early going, but we're going to continue to watch throughout the day. The ideal situation would be for this 160 level to hold and for the RSI to hold in bullish ranges, i.e. hold within the 40 to 50 area. Obviously, we don't want to see it become oversold, similar to the dynamics that we saw during more recent sell-offs. The key situation here would be for 160 to hold, for RSI to stay in bullish ranges, and for Chaikin money flow to remain bullish. Now, the sell-off yesterday pushed money flow towards the zero line. The close today is going to be really important for small caps. Now, we've talked about the power bar ratio, how it's bullish there. We got excited about the breakout. A lot of times breakouts happen and they're retested. Holding that retest is a key in determining whether or not this is breakouts for real or if it's a false breakout. If it is a false breakout, we have to start thinking about support down here at the moving averages. So we're going to watch IWM closely today. The close is really going to be important, I think, for the market and for IWM in general. Tech remains a relative leader. Here's the XLK relative to the SPY. So tech select sector spider relative to the S&P 500 ETF. Went into a summer consolidation and then broke out, and now we're going into a bit of a near-term consolidation above that breakout level. This was a breakout from an ascending triangle. For those of you who are interested in classical charting, we can employ a lot of the same techniques that we do on price on an absolute basis to the relative performance. So here, the key would be holding this breakout level for tech. Similarly, we can look at the RSI of this relationship. It has not become oversold really for the past year. Has not become oversold. We want to see it hold bullish ranges to indicate that tech is remaining strong leadership. Right now, that does remain the case. And on an absolute basis, we can see that nice solid uptrend off those December 2018 lows. Remember, it was a year ago around this time that the market was precipitously falling. Tech started to rebound a little bit ahead of the market and has continued to trend higher. So on an absolute basis, the trend remains higher. On a relative basis, the trend remains higher, confirmed by momentum holding bullish ranges. So we continue to focus on the technology group. We'll look for opportunities there on this pullback in the market. And here's that chart of discretionary that I was talking about. The XLY relative to the SPY. We highlighted this support level last week as the group was falling on a relative basis. It became oversold. We've rebounded from that oversold position. On an absolute basis, we are in a consolidation, but the key for discretionary is going to be continuing to rebound from this level, and then we can start to think about the moving average. That's going to wrap it up for today. Solid week on stock charts with Crypto Week. I will be back here tomorrow.